with us here on Trading Hour. 60 points on the Nifty, so still going strong at this point. Jyotivardhan Jaipuria is joining us right now, founder and managing director, Valuations Advisors. Jyoti, good morning. Good to have you here. You've been cautious on valuations for, I guess, much of this year. So at 10,865, what is your view? You're basically wrapping up this year now.
Yeah, so even now, if you look at it, the markets are not cheap. There was like a period a few weeks ago where the markets are edged nearer to 10,000, where we could be somewhere close to the higher end of the fair value range, and that's where we were putting a bit of money back to work. But we've seen a nice rally, and now again valuations are not exactly cheap. See, the other thing which I've been trying to highlight is we have to juxtapose this with the fact that we are probably close to the bottom of the earnings cycle, so we'll have a strong earnings cycle going ahead. So we could look with and live with a probably slightly higher valuation, but probably not at this level. I think partly what we are seeing now is the year-end Santa Claus rally, which is probably a phenomenon we get in most of the year ends, and that tends to unwind itself somewhere in January, February.
Okay. Jyoti, hi, morning. We have the last Fed meet taking place this week. Do you think that the market has factored in another rate hike?
I think the general consensus is there will be a rate hike. I expect a rate hike this year. I think what is more interesting to look at in this Fed meet is not whether, I think they'll probably do a rate hike, but it is whether they start giving a view that next year the rate hikes will not be as sharp as what market is factoring in. So the general consensus used to be another 4 rate hikes next year, which has now moved closer to 3 rate hikes. And I think that's where probably we could see better markets for emerging markets next year, where we see that Fed is probably not going to hike as aggressively as they were hiking this year because the US economy starts to slow down. So I would say we get a rate hike this year, but probably we start getting commentary which indicates that the rate hike next year is not going to be as quick as what was earlier believed.
Just to press upon that point from the recent events and the market reaction to it, is it in sharp contrast, Jyoti, or do you think it all makes sense? As you said, market liquidity conditions, etc. Foreigners, for example, would be away. Do you expect them to act more forcefully once they return in full force to some of the events we've seen, elections, RBI, the exit, etc.?
Yeah, so if we see for India per se over the next 4-5 months, there would be some focus on politics, because that's something which we can't ignore in the run-up to elections. People would have one eye there, and generally people don't like uncertainty. So all of us know that if we look at longer term, which government is formed and all is not very important to the market. But at the same time, nearer the elections, people generally don't want change. They just want status quo to continue, so that we can ignore politics and get back to company fundamentals. So to that extent, people will be a little nervous ahead of the elections. I think, but what we could get with the Fed, and that's what is probably more significant, is if you look at the last 10 years, it's been all about US doing much better than the emerging markets. So maybe if we get Fed starting to not hike as aggressively, and the US dollar, which has been strong, starts to taper off, then maybe we have a phase where actually emerging markets start to outperform the developed markets. And that is something which, like, I believe will happen. That's what some of the other analysts and strategists are beginning to believe also. So maybe what we start having a phase somewhere next year is where emerging markets start to do better than developed markets. So that would be good for India. It would be good for all the emerging markets.
Jyoti, do you think next year is probably going to be better for a couple of companies such as Jet?
I don't know about specific companies, but I think next year will be better in terms of the market. I think next year will be better for actually small cap and mid cap relative to this year, because if you see the last 20 years, there's not been a year where or there's not been 2 consecutive negative years in mid caps and small caps. So, and there's not been 2 consecutive years where the mid caps have underperformed the large caps. So I think next year will be a better year in terms of market overall. It may not be linear better in the sense that every month may not be better. A lot of returns could be back-ended. But I think we'll end 2019 with better markets both for large cap and mid cap, and second is mid cap will probably outperform the large cap.
Everyone we speak to seems to emphasize two things. Not everyone, but most people. One is how corporate banks are still cheap because they've underperformed so much over the last couple of years. And second, the industrial economy should do much better. Do you agree? Do you agree with those themes?
Yeah, I agree. In fact, like if we go back to some of the other interviews, we were amongst the first ones to really shout about this industrials, because that's been one of our largest overweights through the course of this year. A lot of this is like, if we go back, a lot of these are cycles, right? So the last 10 years, what we've had is consumers doing very well. Industrials have got derated because there's been no private sector capex. But what we are seeing now is, because of no capacity additions over the last 10 years, as utilization levels have picked up a lot in this. And we are invested in a couple of companies where today we are having a problem of capacity. There's order book sitting, they can't execute it because the capacity is not there. So I think the next few years, all these stocks will start to come into focus. The consumer stocks are trading very expensive. These things are trading relatively very cheap if you look at them at the bottom of the earnings cycle. And I think that's where there'll be a shift in the sectoral preferences, where industrials will start to do well, the corporate banks will do well.
Which are these companies, Jyoti? The capacity utilization is so high.
Okay, so a lot of these, without naming companies, it's companies in the machine tool sector, companies in the hydraulic equipment sector. So a lot of them are starting to see this turnaround. And you're probably seeing it in, like if you see the bedding companies in the last quarter, top line growth for a lot of them was like in the 15% range. So you're starting to see a lot of these show improving top line. And at some point, operating margins will be very strong for them.
Jyoti, it's a pleasure. Thanks very much. Appreciate you joining in. And if we don't see you, in the next 15 days, season's greetings. Wish you a very good 2019 from all of us here. Thanks indeed. Okay, we'll take a very quick break here. The market's up back 63. So, that small weakness which was creeping has disappeared, and the market's, back to where we started. Still absolutely status quo, no big change, 60 plus points on the Nifty. After tumultuous 2018, how are markets poised for election year 2019? Well, here is some opinion from market veteran Ramesh Damani and Govind Parekh. Listen in.
Through the kitchen sink of the market, we lost the elections, the RBI governor changed, Dow was down, trade was going around the world. The minute all those events were over, the market rebounded to 100 points. That's bull market action. So bear markets have signals when they start. There'll be leverage in the system, a lot of happy talk in the market, everyone will be invested, everyone talking stocks. The proverbial panwala will be giving you tips. We don't see any of that right now. I think the bull market is intact, and in my opinion, it's still got a ways to go. People vote differently within state elections and national elections. So because the BJP lost 0-3, for example, I'm not pessimistic about their chances to come in the national election. Having said that, even if there's a surprise, India grows at night. Governments in India will make us grow at 6-7%. A good government will make us grow at 10%. That doesn't ever seem to happen in India. But we'll still grow at 6-7%. Nothing wrong with that. And great businesses will still make us a lot of money.
A lot of things are going to depend on the international scenario. My opinion is that there will be a lot of volatility in the market. So themes as such, capital goods, of course, they have to do well if India has to grow at 7-8%. And I think even entertainment sector, casinos and hotels and properties in hill stations and all that will do very well, because the number of working hours is going to reduce substantially over a period of time. Most of the people then what do they do? So, and today with the communications, I can sit in Kunur or Kodaikanal and do the business. I don't have to buy a property in proper Chennai. So, and a lot of people will go on holidays. I think that sector, airlines, all these things are going to do extremely well.
Okay, that's some opinion. We're wrapping up the year, and of course looking ahead. But in terms of talking about wrapping up, let's look through the lens of various sectors in some detail, month by month, big event by event. And let's kick it off with the banking space. Abhishek Kothari is here with the rewind for the banking space for us 2018. What were the highlights, Abhishek?
Well, Prashant, it was a Swachh BFSI Abhiyan undertaken in 2018. So 2018 was a year of Swachhata and Parivartan in the banks and finance sector with focus on asset quality, management changes that we saw, NBFC valuations and consolidation. But after a very, vulnerable 2018, 2019 promises to be much better on account of the NCLT recovery and the growth that we are seeing. So how did the 2018 begin? It began with the Nirav Modi scam. RBI decided to crack whip on the asset quality and barred restructuring of loans, as a result of which the RBI's action, the banks reported the worst ever quarterly performance with a loss of over 55,000 crore in the Jan to March quarter, with gross NPAs in absolute value rising to over rupees 10 lakh crore. That was up almost 16% on a sequential basis. So the big cleanup was over, and in the month of September we saw the losses falling sharply. So they reduced to about 3,731 crore of what we saw in the Jan to March of 55,000 crores. So, but the other big theme that we saw was the change in various managements that we saw. It began with Axis Bank. We saw Shikhar Sharma's tenure, which was cut down from June 2021 to about December 2018, and the bank immediately got Amitabh Chaudhary being inducted. ICICI Bank, on the other hand, also saw Chanda Kochhar stepping down early amidst controversies over some loans given to the Videocon group, and Sandeep Bakshi actually taking charge over there. Rana Kapoor at Yes Bank is also set to step down at the end of Jan 2019 to make way for a new MD and CEO. But perhaps the biggest change that we saw in the roles were at the central bank, with Urjit Patel resigning following a standoff with the government on several issues, and veteran bureaucrat Shakti Kanta Das taking charge as the RBI governor. 2018 was also the year where NBFC saw the Swachhata in their valuations. So the spotlight actually began with the risky practices that they undertook, which got exposed after IL&FS defaulted on the repayments. This caused a credit scare and saw liquidity actually drying up and bond yields actually rising. So shares of NBFC saw a sharp correction by 30 to 50%, which led to massive correction in the valuations of NBFC. But one NBFC got closer to a dream deal was Capital First, which is set to turn into a bank after integrating with IDFC Bank. Consolidation, on the other hand, will also move ahead next year when we see state-owned banks like Bank of Baroda merging Dena Bank and Vijaya Bank with itself early next year, that is by March 2019. Looking ahead, 2019 seems to be a very good year for banking sector. Credit growth has picked up to 15%. Now, if you compare this 15% on a base, it looks like a base effect of 15%, but the absolute amount, YTD growth, has been as good as the whole of fiscal 2018. So the picture for banks with better capitalization looks really good, while the picture will not be the same for NBFCs, especially in the housing finance sector and vehicle finance sector. However, in the NBFC sector, we'll see growth amongst gold financing and consumer finance NBFCs. Back to you.
Some F&O strategies now. Rahul Shah of Motilal Oswal is with us. Rahul, over to you. Strategies in stocks as well as index?
Yeah, hi. Good morning. I think the way the markets have been, I think obviously we are into the grip of bulls. So I think large caps has been doing quite well since last few sessions, and I feel still it will continue to do well. So in that space, I think corporate banks as a sector has done quite well. So ICICI, Axis, both have run up from the near-term low. So I feel the third bank which can move on is from the SBI. So stock has given good longs built up as well as technical breakouts. So I would go long on SBI with a stop loss of 285 and target of 305. Second idea is L&T. So we've seen L&T taking a support at around 1350 and again bouncing back smartly. So my sense is again this stock can go to a new territory and it can go to 1465 to 1475 levels. So stop loss near term could be 1390 and one can go long. And third, again, being from the FMCG pack, we've seen the entire FMCG pack done quite well in last few sessions. So I feel ITC has been laggard, and I think stock has got a good support at 274 or odd levels. So near term, I think ITC can blast from here to 285, 286 level with a small stop loss of 275. So I think these are the three top ideas in stock.
Oh.